Right, so we're live on this video now, and it's going to be a Q&A video with my friend Harris from university. And so he's a beginner investor, and we're just going to go through some beginner questions. Well, we call them beginner questions, but some of them are quite, what would you say, detailed questions? Some of them are quite
a bit more in-depth
questions, but I'll go through it all, and if it goes over 15 minutes, we'll do the video in two parts. So, yep, we're definitely recording. So let me turn the volume up as well, so they can hear you also. Right, the volume's up fully. Right, so just fire ahead your first question then.
Right, so first question, Sam, is what are some tips on what to avoid when it comes to a beginner investing?
Okay, so things to avoid. So what I'll mention also is that there's a difference between trading and investing. So for example, with investing, you're looking for more long-term gains. So if you was investing in, say, for example, what's this we're looking at here? How does it? Oh, Coca-Cola. Let me change it to a more longer term. So if it's more longer term, you can see that obviously there was a big drop here, right? You can see the big drop. I should really change my mouse for these videos as well, so it's a bigger mouse. But can you see the big long drop there?
Yeah, I can see that.
So if you was investing, like if you say for example, if you was trading this, trading's done with margin and leverage. So some of it's on debt. So for example, if you was trading this and it drops all of this way, you'd probably had a margin call and your positions would have probably been closed. So the first thing is I'd probably say don't invest if you're using a trading 2 account. Don't try and invest with a CFD account, because this is a different instrument. So this is debt basically. This is a derivative. So like when you're investing, make sure that you're doing it with actual stocks. So here you can see it's a bit small, the screen. Let's see if I can zoom it in a bit. There we go, that's better. So it's on Boeing now, but the principle's the same. So So, and also if you're going to do it, make sure you use the ISA account, because you're not taxed on this, and you can put up to £20,000 a year, I think, in the ISA account. So make sure you do it in an ISA account, and also make sure it's the actual stocks and not the CFDs, because if it drops its value, you'll lose. Your broker will close your positions, and you'll lose all of your money. Whereas, like, if you're investing in stocks, like the lowest, basically your positions won't be closed, but like if it can drop in price, but you will never lose all of your money. So that's that, unless like the company goes bust. But your positions will never be closed. And also, if you're if you're trading, this isn't necessarily investing, but if you're trading and you take out a short position, which is basically betting on the market going down. For example, if you're long and you're hoping the price is going to go up so you can sell at a profit, right? And the dividend comes, then you get paid a dividend. But if you're short and you want it to go down and the dividend comes, you actually have to pay the dividend, which not a lot of people know. So you can actually lose a lot of money doing that. Another thing for a beginner investor, what else would I say? For a beginner investor, I'd probably say understand fundamental analysis, which is like balance sheets, income statements, what the directors are of the company, all of these things. But then also understand the technicals, which is what the graphs are and what the graphs do. Probably trade with, probably start a practice account first and paper trade, because you'll make mistakes at first. And it's better to learn with virtual money rather than real money.
I've been doing that on the trading 2 and 2. I was gonna ask you about that now, because on your screen there's the CFD invest and then ISA, and you're invested in the ISA, aren't you?
Yeah, most of the money's in the ISA. Yeah.
On the virtual trading 2 and 2 up, I don't know if you can see, there's just two options, and there's no ISA on the virtual one. So But I've been using the invest one, the second one.
Yeah.
So what's the difference?
So, so the difference between these is the
Yeah.
CFD account is derivatives. So it is a financial instrument that derives its value from the stock itself, and it allows you to buy more than you actually have money for by using leverage, which is debt, right?
Right.
So, but that basically means that if your account falls below a certain value, you have to put more money in because you're coming close to your margin. So for example here, if I click on my CFD,
Yeah. Just close my window. Yeah, because I don't think they have the ISA on the up unless I'm missing it. I don't know.
so basically if I click this one, it should show somewhere. It should show basically what my margin is. Here it is. There we go. So can you see that at here you would get your margin call,
Yeah.
and here your positions will close. Whereas on the invest one, that wouldn't happen because you're not using leverage.
Right.
So this one is more, so it's more risky to trade, right? But
Yeah.
basically the reason for the leverage is that if you're trading, you want basically high returns with a low drawdown. And if you have a low drawdown, then you can make like a load of money by using leverage. But you have to, do you know what a drawdown is?
No, I don't know what drawdown is.
So say for example, your drawdown is what's your maximum decrease in a value in the value of your investments. So for example, if you had a big drawdown on your investing, it wouldn't really have an effect. Whereas if you had a big drawdown on your trading, you could get a margin call, and if you can't add extra money to fulfill the margin requirements, your positions will close. And it's happened to me before where I've had a margin call and the positions have been closed. And because you mentioned you had a question about if I've ever lost money. Which question was that? Because we'll lead on to that one.
Yeah, I asked you, since you started investing, have you lost any money? What did you learn? And since then, what have you done to avoid those same mistakes? Or are they inevitable? Inevitable? Can they just happen at any time?
Mistakes are inevitable. That's why you should keep a notebook of what you did good, what you did bad, and what you can do to improve. Because you're always constantly learning when it comes to trading. So you need to keep a note of the mistakes you've made, because you will make mistakes. It's probably good to research what mistakes other people have made as well. But the biggest loss I made was when I had basically a margin call and my positions were closed, and that was my biggest ever loss as well. I lost a couple £100 with that. And basically that was also, and this will lead on to the second mistake,
was this a CFD account?
This was the CFD account, yes.
Right.
And basically the other mistake was investing in what you don't know. So try to avoid investing in what you don't know. So I made this loss because Trading 212 also has an app which it's linked to called ProQuant, where people make trading algorithms, and you can basically follow the algorithms. And so this algorithm was making like 400% returns a month. So I put all of my money into it, and then it had a big drawdown, and my positions ended up closed. So I lost all of my money. So another thing I'd probably say is, for a beginner, is to make sure you diversify. Don't put all of your eggs in one basket. If there's like a really good stock that's like performing 1,000% all at once, it's easy to go, oh my God, this is going to make me a millionaire.
Yeah.
But you put all of your money into that and then it crashes and you've lost everything. So invest some money in different stocks. Don't just basically diversify different industries, different companies, different strategies. Just make sure you spread your risk. So that's what I would say for that question. So we're coming on to 10 minutes. So just fire another question away.
That was one question. Right, I'll spot you.
Well, we did two questions there, didn't we? Because we did the mistakes one as well.
The second one as well, I asked, what is a piece of advice you wish you were told when you first started investing? You kind of touched on that a bit. So I'll leave that one out. So you did mention that it's good to read financial data and stuff like that, such as the charts of the market going up and down. But how would we go about that? In one of your recent videos, you talked about, you said your investment will be worth more once you make a decision before it reaches the news. How would we actually go about that? How could we read data to make a decision before it actually does reach the news, or is that like really far reach, like it's kind of impossible?
So this comes into the efficient market hypothesis. So which basically says that as soon as this is one theory of the efficient market hypothesis, which I'd
Yeah.
recommend as a beginner investor learning the different forms of the efficient market hypothesis. But they teach this in university, but in reality, from all of the professional investors I've spoken to, nobody believes that the efficient market hypothesis is true. Nobody believes that markets are efficient. Even I don't believe markets are efficient because obviously behavioral economics comes in. So that means that humans don't act rationally. For example, there's herding bias, people will just go with the crowd, people will be fearful, people will be greedy. For example, markets fall faster than they rise. There's loads of it's called heuristics, I think, behavioral heuristics, which are basically mistakes humans make. So to be a good trader, you have to be very rational. You can't be emotional. You've got to be extremely rational. Um, and so coming back to the original question, can you just go through it again? Because I'm forgetting what it was.
So when you first started, or obviously you did finance in uni as well, so it
Yeah,
could
yeah.
be. Well, how do we like?
Oh, the news thing.
When a beginner sees your screen right now, they're gonna see that big graph and it going up and down and all the numbers, and it becomes a bit overwhelming, a bit confusing. What actually is that on your screen? Like, how would you read that? How would you instantly look at a company's financial performance and see, okay, they're doing well, they're doing bad? You look at their numbers. What numbers do you look at and be like, all right, this is a stock that's worth investing in? So yeah.
Um, yeah, so I'll come to this because I just want to touch on the news thing again that you mentioned.
All right.
Like how do you know before the news comes out?
Oh, it reaches, yeah.
And that's actually really, really hard. Like, I mean, one way is insider trading. So you actually have an insider tell you the news before it comes publicly, but that's illegal. So insider trading is actually illegal.
Do you think it happens with like actual traders or like you said insider trading? What about the actual guy himself? That's
So you've touched on something really, really good here. So technically, you could technically know before the news comes out by like watching the share price, watching the volume. So I think there's different indicators here. So there should be volume. So I've not used any of these in ages. So maybe it's on balance volume, is it? Let's just see. So this will come up here, and like if there's a massive increase in volume, and then the share price is going down at the same time, and on some of them you can actually see who's making the sales, and if you're seeing like mass loads of people selling before, say for example, like a news report about the company's annual earnings comes out, and the news report hasn't happened yet, but there's a high volume of people selling, or one person specifically selling. This might mean that there's insiders that know what's going on before the news, and so you can use this as an indicator that, oh, the news is going to be bad, and then start shorting the stock, or if it starts going up, buying the stock. And also just experience and gut feeling. Like once you're experienced, you can kind of have a feeling for whether it's going to be on the news. And also there's also like what is the news, like the mainstream news, alternative news. I mean, it probably just. I mean, it's hard to know what's going, like it's hard to know before the news comes out, really. I mean, you
yeah.
can you can look at trends, But the news will change the trend. So, for example, the news will change the trend basically. So, and it's impossible to predict the news.
Yeah.
So
No, definitely.
it's actually really hard. Like it's actually really hard. But you can kind of predict the future performance of a company from its financial data, from its history, because
Yeah.
history repeats itself. Like history rhymes, history repeats. So you can technically see where the company is going by analyzing its history. But
Yeah.
at the same time, it's kind of like driving your car whilst looking through the rear view mirror.
Yeah. Yeah. Yeah.
There are
So
indicators. So, for example, um, so for example, there's other indicators here, and oh, it's not showing them. Basically, you have like lagging indicators, and so these will like kind of I don't even know really, but there's like there we go, lagging indicators and leading indicators. So some indicators will be lagging and some will be leading. So one will kind of show you like the slight past and how this is going to happen, and then one might show you how what could potentially happen in the future. But you never really know, so that's why you have to set a if you're trading, you have to set a stop loss and a take profit. But there really is a massive difference between trading and investing. Investing is more volatile, and like a long term thing.
yeah.
And if you're investing, like Warren Buffett's school of thought's probably best, like do a discounted cash flow, and then buy cheap companies that you think are going to do well, and then just wait. And also with investing is you should have like an investment portfolio. So for example, Ray Dalio All Weather. So if you're investing, you need a balanced portfolio.
Yeah.
So this is completely different to trading. You want, so according to Ray Dalio, you want 21% in US stocks, 9% in foreign stocks, 55% in US bonds, 7% in diversified commodities, 8% in gold, and 0% in real estate. Although, to be honest, all of these graphs will probably be different. All of them will probably be different, so it's probably best to actually go to the source, go to the Ray Dalio website probably. But essentially, have some US stocks, have some foreign stocks, some bonds, some gold, because
You mentioned earlier.
basically invest in companies in different sectors. So like that have, so say for example, invest in I don't know, gold mining stocks and I don't know luxury brands.
Yeah.
And basically in a recession or a crash, gold mining stocks will go up and the luxury brands will go down, but they will offset each other. Do you understand what I mean?
Yeah.
And also, if there's a crash and you have got money invested in gold or some money invested in cash, basically when the stocks are cheap, you can then invest more money into stocks.
Yeah.
Whereas if all of your money are all in stocks, then you've just lost all of your wealth, basically. So having some in cash is like a hedge against the risk.
Yeah.
So if the stocks lose the value, you still have cash to spend on things, to pay your rent, to buy food, and also some to reinvest.
Yeah.
So kind of like hedging your risks, being diversified. Being diversified is very important for investing. So I'd say that as well. What are we on here? We're coming up to 20 minutes, so we'll end the video here. It might be 3 parts, so we'll end the video here, and then we'll start part 2, shall we?
Yeah, that sounds good. Yeah.
Okay, right. So thank you guys for this episode, and we'll see you in the next episode. Yeah. All right. Cheers. Let me turn it off here.